In September 2008, one of the biggest banks in the world collapsed in a single weekend. Stock markets crashed. Millions of people lost their homes. Governments had to step in with trillions of dollars just to stop the entire financial system from falling apart. But how does something like this even happen? How does a housing problem in America turn into a crisis that shakes the whole world? To understand that, we have to go back a few years to a time when banks were handing out home loans like candy. For decades, getting a mortgage meant proving you could actually pay it back. Banks checked your income, your credit history, your job stability. But in the early 2000s, that started to change. Housing prices were rising every year, and banks realized they could make money by lending to almost anyone, even people with poor credit or no steady income. These became known as subprime mortgages. The logic seemed simple. Even if the borrower couldn't pay, the bank could just take the house back and sell it, since home prices kept going up anyway. So banks started approving loans with little to no proof of income. Some buyers didn't even need a down payment. It was fast, easy money for the banks and the borrowers alike, at least for a while. Here's where things got complicated. Banks didn't just want to sit on these risky loans, so they bundled thousands of mortgages together into a single investment product called a mortgage-backed security. Instead of one bank holding the risk of one loan, that risk got sliced up and sold to investors all over the world, pension funds, other banks, insurance companies. On top of that, rating agencies, the companies whose job is to judge how risky an investment is, gave many of these bundles high safety ratings, even though they were full of shaky loans. Investors trusted those ratings and bought in heavily, not realizing how fragile the foundation really was. So now, if homeowners started defaulting, the damage wasn't contained to one bank. It was spread across the entire global financial system. By 2007, housing prices stopped rising, then started falling. Homeowners who'd taken out risky loans began defaulting in large numbers. Suddenly, all those mortgage-backed securities that were supposed to be safe were worth far less than investors thought. Banks that held huge amounts of these investments started reporting massive losses. In September 2008, Lehman Brothers, one of the largest investment banks in the world, collapsed, unable to cover its losses. Because banks were so interconnected, this triggered panic. Banks stopped trusting each other and stopped lending. Even short-term loans between banks froze up. Without that lending, the whole financial system started seizing up, like an engine running out of oil. Governments around the world stepped in, injecting trillions of dollars to stabilize banks and prevent total collapse. In the US, this included the Troubled Asset Relief Program. Despite the bailouts, the damage was already done. Unemployment spiked, home foreclosures skyrocketed, and the global economy fell into what's now called the Great Recession, one of the worst economic downturns since the 1930s. In the years after, regulators introduced new rules to make banks hold more capital and take on less risk, trying to prevent something like this from happening again. The 2008 crisis is a reminder of how connected the financial world really is and how a problem that starts small can spread fast when risk isn't properly understood or controlled. Next time, we'll look at what actually makes a market bubble and how you can spot the warning signs before they burst. If you found this useful, subscribe for more stories like this.